Tyler, a lot of investors are looking at UPS right now. You see the trucks everywhere. You think about the growth of e-commerce and how so much of the world has changed and the needs for logistics, especially like the last mile, but also just getting packages from end to end, the whole entire ecosystem. Plus, you factor in that the stock is down and you get a lot of people thinking, hey, maybe it's time to buy UPS on the dip. A lot of people are looking at FedEx too. It's another popular name out there. But Tyler, there's a whole lot of other companies in the logistics business that have been better investments than UPS and FedEx. You see them down here at the bottom. Are you ready to talk about one of those that we think is a much better run business right now?
I actually love when we can talk about undercovered, underappreciated businesses that normally kick the crap out of the more popular companies that everybody knows.
This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/The Smattering. The Motley Fool is going to give you its 10 best stocks to buy right now. Those people know what they're talking about. Check that link out after this video. All right, Tyler, let's do this. UPS, the stock's down roughly 15% or so this year. Looks like it's trading for an okay valuation, and we know it's a stalwart. We know it's a good business. What's one that you would rather talk about right now that you think is far better run and maybe should be on people's watch lists?
I will do that in a minute, but first I want to indulge me for a minute because I want to talk about something.
Consider yourself indulged, Tyler. Do it.
I want to talk about the idea of very good businesses, but not necessarily businesses that are conducive to shareholder returns. And I think UPS kind of falls into that bucket. In terms of competitive moats or economic moats, one of the things that UPS, FedEx, you could maybe even argue Amazon with some of its logistics that it's building out today. It's an extremely hard barrier to entry. Pretty much the only reason that Amazon is now in this is because it just happened to be the company that could indiscriminately plow, I don't know, 20, 30, 50 billion dollars into logistics, and it just be a thing because there's no startup in the world. It's just, I've got $50 billion. I'm going to make a logistics company.
It's a tough business. It's capital intensive. It's relatively low margin. It's cyclical. Like, factor all the things in why it's a terrible thing to do as a standalone business to start today. Amazon is a rarity, right? And they've built this model of kind of being their own first best customer. You think about AWS. They had a bunch of compute power that they needed internally. Hey, well, we can sell some of that capacity for good money. You think about Fulfilled by Amazon, their internal logistics. Again, they have the warehouses. Instead of letting that space sit empty, let's let people that are selling on our platform, hey, you can rent this space in here and we'll do the fulfillment for you. Yeah. Oh, we're paying UPS and FedEx to ship these packages. Why don't we build our own logistics business? They had a use case that made sense. So again, It is the rarity. But to your point, just because they're really great businesses, sometimes the return profile doesn't mean it's going to be a great investment.
And you touched on it a little bit there with the idea it's a little bit cyclical. It can be very seasonal. We all know that the package season, it tends to strain these companies pretty hard during the holiday season, which means that they have to ramp and build capacity specifically for the holiday season. And then afterwards, it's pretty much underutilized capacity. I understand there's some flexibility to it, but
you know how to kill your returns, Tyler? Buy a $120,000 Class 8 tractor that you use 2 months out of the year. That's a good way to kill your returns. So that's the key, right? That's the key. They have to be so lean and efficient in their peak times so that the other periods of time, they're still able to get by.
To their credit, US has made some very deliberate moves to increase profitability. The new CEO, I think it's Carol Tomei. I hope I'm saying her last name right. But one of the things that they did was a value over volume business. They wanted to get into the business to business logistics of parcel delivery. They wanted to get into things like delivery of medical products and things like that that are much higher margin than just package delivery. Unfortunately, package delivery, especially on the small stuff, and even worse on the big bulky stuff. If you're those silly people that are buying pianos on Amazon, that stuff kills margins for these kind of companies. So when you have things like that, to their credit, they are doing the best that they can, but this is just a business that is absolutely brutal. It is very hard to do. And especially with packages, because it is all the things that we just said, it just hasn't necessarily been conducive for long-term shareholder returns, more or less. I'm generalizing here, but I'm pretty directionally correct. US and FedEx over the very long term have more or less tracked the S&P 500 in terms of total returns. It may be 25% to one side, 25% to the other, which over 20, 30 years, that's pretty close, right? So when you think about that, you go, why would I want to take on the risk of owning an individual company that more or less gets market returns? I can spread that bet around 500 different companies and not have to worry about, I don't know, some sort of bad thing happening at this one company that could ruin my returns. And so when you look at that value proposition, you go, maybe I should be looking elsewhere in the transportation business for something that can generate a higher return that maybe just doesn't have the name cachet of the UPS truck that comes to my house twice a week to drop off, or I don't know. How many times do they stop at your house, Jason?
I refuse to admit that number. Let's go ahead and change the subject on that point. In the value chain of logistics, there are pockets where you can make good margin, where you can make good money. If you have the right sort of operation, you've built your business in a specific way, and you're really rigorous on costs and delivering for your customers exactly what they expect. Because all of the tailwinds of the things that we've talked about, they affect some of these other pockets as well. And one of the companies that's built to sit in this really well is Old Dominion Freight Line. Tyler, they focus on less than load models is their model. So you've got these 50-foot trailers where you may not have a full load. Old Dominion is going to figure out a way to bundle your load with other customers' loads. It's all going to the same place to maximize the efficiency of that. And they're going to make a pretty good profit. You're going to save some money, but they're going to make pretty good profit on it by bundling everything together.
Yeah, I've been following Old Dominion for a long time. And one of the things that has astounded me for so long is their ability of just running an extremely efficient, extremely tight ship in terms of operations, of operational efficiency. A really good less than truckload company tends to operate with an operating margin somewhere in the 15 to 20%. If you're doing that, you're crushing it as a less than truckload company. Old Dominion, as of recently, has been putting up operation margins closer to the 25% range. And a couple times, I think they've hit as high as 30.
You can see, again, this is looking over the past decade, consistently in the mid to upper teens. And then in recent years, it's moved into the 20s. Whereas, again, UPS, just a comparison, has never come close. And the trend is not, they're working on fixing this. We talked about that. They're working on improving those margins. But again, the margin profiles of the businesses that they focus on are very different.
With that, because they're not necessarily having to go to every point at like home delivery. It's a lot more like a spoke to spoke model where you go from distribution hub to distribution hub. You can build a lot of efficiency on that system. And Old Dominion has been absolutely spectacular doing this, and it has translated incredibly well to shareholder returns over the past 10 years. Over the past decade, total returns for Old Dominion are somewhere above 1,000%, which
it's been an 11 bagger. This is their network, just to give you an idea of their scale. And this is one of the things that as they've built this out over the past couple of decades, that has allowed them to continue to improve those margins, because they're able to pair more customers to markets that they serve, growing revenue while growing profits at the same time.
More nodes increases capacity, increases capability, and it's a nice virtuous cycle. And again, so like I said, returns on this have been absolutely spectacular. Now, typically when we do these sort of videos, I think Jason, you and I, we like to give whether or not these are stocks to buy. And as wonderful as a business Old Dominion is, you have to look at that stock price and go, is it really worth it? Because if we want to talk about highly valued companies, Old Dominion is a textbook example of a stock selling for a premium valuation right now.
Yeah, I agree. And that's why when we kicked off the video, I very specifically said stock to put on your watch list, because the bottom line is, and you look at these two again, you've got UPS, I'm going to do a more recent chart just so it's not as lumpy, but trading for about 15 times earnings versus 34 times for Old Dominion. Should Old Dominion trade for higher premium? Yeah, absolutely it could. We've talked about it. It delivers nearly triple the operating margin. Its return on assets are substantially higher. It is a more profitable, higher return business. It should trade for a higher premium. But 34 times earnings, this is not a hyper growth business. It's already in almost every state. It has massive scale at this point. Can it continue to grow? Sure. It's probably going to be able to grow GDP plus a little because again, the tailwinds are favorable. You think about onshoring, continue expansion of e-commerce, logistics getting more complicated, less than
Toss in
truckload demand,
toss in
all that stuff.
management, buying back shares. So you get the juice
Yeah.
a little bit higher than revenues.
Again, that's the key. Earnings per share is going to grow, should grow higher than that because of all of the levers that they can pull. Again, 34 times earnings is a high premium to pay for this business. If you start seeing this multiple fall to mid 20s, I think that's attractive. A cyclical seasonal business. Eventually, the market's going to get bad. Eventually, the economy's not going to look too good, and investors are going to run from stocks like this. And then that's the time that are you ready?
In case of emergency, break glass. That's where Old Dominion stock sticks.
No, you back up the truck, Tyler.
Oh, dad joke.